Recent data from the FHFA and S&P CoreLogic Case-Shiller Indices confirm that while home prices are still increasing year over year, the pace of growth has significantly slowed. In fact, the growth rate is now at its lowest in over a decade. However, this doesn't mean prices are declining. Rather, the rapid acceleration seen in recent years has leveled off. The FHFA's House Price Index shows a slight decline of 0.2% in June compared to May, though year over year, home prices are still up by 2.9%. Every region across the U.S. is experiencing positive growth, with the Middle Atlantic seeing the highest increase at 6.7%. But the data also shows that 2 consecutive months of small declines in seasonally adjusted values indicate the once red-hot housing market is cooling down. Looking at the Case-Shiller Index, which tracks short-term fluctuations, we see a similar trend. While home prices rose by 0.4% from May to June, the seasonally adjusted figures show a decline of 0.3%. The 20-city Composite Index, which represents major cities, shows a 0.3% drop from May to June, though it's still up by 2.1% year over year. This deceleration is noticeable in even the hottest markets, where price growth is now more moderate. So, what does this mean for the housing market? Prices are still higher than last year, but the rate of growth is easing. For buyers, this could signal a more stable market with fewer rapid price increases. Sellers, on the other hand, may need to adjust their listing prices to reflect current demand levels. In summary, while home prices continue to rise, the momentum driving these increases has slowed, and the market is now adjusting to higher borrowing costs, more available inventory, and softer buyer demand. The next few months will be critical to see if this trend stabilizes or if we enter a more significant cooling phase. For direct financing consultations or mortgage options, visit Nadlan Capital Group.